Hello, welcome to a recap of our lecture on financial instruments and how we treat them. Remember, we already know how to classify them. We did that in the last lecture. We're now looking at the treatment. So, classification at amortized cost, how do we treat that? Well, we're going to use this table. It's always the same. We start with our opening balance, either on an asset or a liability. The effective interest increases that opening balance, interest paid decreases it, and that gives us the closing balance in each year. It's simply the debits and credits that are different. So assets, first of all, remember we recognise them at cost plus transaction costs. The effective interest in the year then will be debited to the asset to increase it and credited to the income statement as finance income. Interest actually paid in the year, well, we debit cash with the amount we received and we credit the asset to reduce it. So that's how we deal with the debits and credits on this, and we did illustrations 1 and 2 to make sure we could do it. For liabilities, we use the same table. We recognise the net proceeds, i.e. we take out discounts or costs, those sorts of things. Again, we open our opening balance, then we deal with the effective interest. It will be debited to the income statement this time as a finance cost and credited to the liability to increase it. So the effective interest increases the opening balance on the liability. The interest will be paid by us this time. We debit the liability and credit cash paid with the amount that we paid. And we looked at illustration 3 to make sure that we could do this. We then looked at whenever we classify at fair value through profit and loss, how do we do the treatment for that? Well, we remeasure to fair value each year. We do that based on current market prices, revalue to the new amount, and the gain or loss between the old value and the new value will go directly to the income statement. Again, we did illustration 4 on this. The only other one that left was fair value through other comprehensive income. Again, we revalued to the new amount each year, and then the gain or loss went to other comprehensive income, i.e. was shown in reserves rather than going to the income statement. So that went to reserves. Just a couple of things on some liabilities that we need to be aware of. When it comes to preference shares, if they are irredeemable, they'll be classified as equity unless they have a fixed dividend, then they would be debt. If they're redeemable, therefore, they will be a financial liability, i.e. they will be classed as debt. Interest and dividends paid then, well, if we pay equity dividends, we will report this directly in equity. And if we pay preference dividends, they will be on redeemable shares and that will be shown in the P&L. We'll expense that in the profit and loss. So the last thing we looked at in this session was compound instruments. So what were we talking about? Well, they were issued by us to raise capital and they were equity or debt. They had characteristics of both. So what we were saying really was convertible debt. We'd issued some convertible debt that had characteristics of debt and equity. What did we need to do from our point of view? Well, we're issuing this to raise capital. So we're always looking at it from the issuer's point of view. And we're saying, how do we need to deal with this? Well, IAS 32 says that we need to split the convertible debt in two. At inception, we need to split it into the debt bit and the equity bit. So the debt bit we did as the present value of the future cash flows. So we got the discounted amount of the interest and the capital that would be paid on the debt. And we discounted it at the effective interest rate on a comparable bond with no conversion. We then had the equity as the balancing figure. Okay, and we did that in a detailed example. We subtract issue costs pro rata from the debt and equity, and we did all of that in illustration 5. We then disclosed separately the debt and treated it at amortized cost, and the equity, which remained the same, it remained unchanged. So with convertible debt, we had to split it into its debt component and its equity component, and then treat each separately. And as I said, we did that in a detailed illustration in illustration 5. So that was our lecture on financial instruments treatment.